Good evening, everyone, and thank you so much for joining Brian and his team here in Fort McMurray. I apologize, I was not able to be there in person, but I am happy to share our outlook for 2026. We're going to go through a few slides and mostly just to keep me on track, but at the end of the day, if you have any questions after this, please feel free to pass them along to Brian and his team, and they'll get to me and I'll respond back to you. What I really wanted to chat about today is where we see 2026 shaping up. There are four key themes that we really like over the next 12 months. One of them is monetary stimulus, so that's additional spending from the central banks. You've got fiscal engine, which is all of the government budgets, tax cuts, all of those things that will stimulate the economy. We have the artificial intelligence supercycle and the amount of money that's being poured into infrastructure, building out technology, hardware, and all of the things that trickle down from that is a huge impact for 2026. And we also have the wealth effect wave. We've had 2 years of double-digit growth in equity markets. Bond markets are resilient. We've got good yields today on a balanced portfolio. And we have an opportunity as people who are invested to see our balance sheets expand. And that gives us confidence to start spending as well. So those are the key themes. We're going to talk a little bit about what is happening in the markets as well. So if we go back to last year, it was a phenomenal year. We had a ton of volatility early on. Liberation Day really took a lot of the wind out of our sails when it came to equity markets. But very, very quickly, the Trump administration realized that they are not in the driver's seat when it comes to tariffs, markets, and the reaction of the consumer. Markets plummeted, they were down significantly, and within 9 days, the Trump administration reversed course and tariffs were either renegotiated, dropped entirely, and it was a very, very significant opportunity for investors to add to their portfolios, rebalance, do the things that they needed to do. That was a very quick recovery, and it was an opportunity to kind of lean into the markets. We did exactly that with high profile portfolios. We are in charge of the tactical tilts, and so we took that opportunity. All things equal, we looked at recession risks, we looked at all of the different data points, and we couldn't see any reason why those tariffs would be in place for a long time. And therefore, we made the strategic bet that the tariffs would actually be more bark than bite. If you look at the markets overall, it was actually developed international markets, including the Toronto Stock Exchange, that outperformed the US. So the US was actually the least, sorry, the market was the least productive last year, with Canada and emerging markets and Europe actually outperforming. So it's actually quite interesting to see how the year shaped up, especially with a lot of people focused on artificial intelligence, technology stocks all of last year. So there are a few things that we look at significantly every single day, actually. We look at yield curve, manufacturing output, unemployment rates. And what we've determined is that these 7 indicators are extremely likely to look at what's happening down the road. And none of these are in orange or red. None of them are negative. And when we look at other recession risks that have happened over the last 50 years, you're always looking at, say, a inverted yield curve or very, very high inflation. You look at housing starts plummeting. All of those things are actually the opposite of where they were a few years ago. And so we see a lot of improvement overall. So where are we at? We're not definitely in super growth, low inflation area, but we're in a moderate inflation, moderate growth cycle. And so we're continuing to see that the economies are growing. There's very few signs that a recession is around the corner. When those signs start to creep up, that's when we start to take action and look at, okay, how much equity exposure do we have? And remember that recessions don't last that long. Recessions on average are about 13 months, but the average expansion is over 5 years. So yes, you can have a little bit of an overheated economy, yes, and when a recession happens, those are times to be a little bit more strategic. Now, depending on where you are in your financial plan and your time horizon, that's really going to dictate where you're looking at rebalancing your portfolios and making sure you have a little bit less risk on the table. Global trade is another area that we see a ton of expansion. So global trade is anything that is crossing borders. We have our 5 largest exporters: Japan, South Korea, Germany, US, and China, all having year over year growth, which is in the double digits now. And that's actually a really good sign. The other thing that we look at is interest rates. And so we just came out of a very high interest rate cycle to combat inflation. We believe that inflation has now been taken care of. Yes, things are more expensive, but we don't get lower prices when inflation is flat. The prices just don't grow as fast. So in Canada, we're sitting at 2.25 for the overnight rate. In the US and UK, it's 3.75%. It's likely that the Bank of Canada is not going to cut again this summer, but they could cut by the end of the year a little bit more. And in the US, they're definitely looking at additional cuts. On Friday, there was an announcement that a nomination was in for a new Fed chair. This particular person is of interest to us. We'll be sending out a little bit of information this week on our podcast in regards to our views on that person's position and where they would lead the Fed. But at the end of the day, lower interest rates for the US means a little bit of a lower US dollar and, believe it or not, more stimulus. So cheaper lending equals more borrowing by the consumers and institutions to put back into the economy. So it's actually counterintuitive, because inflation could go up higher in the United States because of the lower interest rates. So we're keeping an eye on that. This goes back to that monetary expansion, is that for years and years, the central banks in Canada and the United States have actually been lowering their balance sheets. So central banks can actually buy assets. It looks as to though that could reverse over the next 12 to 18 months, as the Bank of Canada and the Federal Reserve, specifically the Federal Reserve, were to buy assets. There's lots of rumors out there, but we're watching this closely. And if the balance sheet were to expand again, that's another stimulative measure for the U.S. economy, and that equals higher returns for the stock market. One of the things that probably would be of interest to a lot of you is the US Canadian dollar. And we have seen a significant amount of volatility over the last about 8 to 10 weeks. In the United States, their interest rates are higher, so that they demand a little bit of a higher premium on their dollar. However, with all of the uncertainty around tariffs and threats by the Trump administration, they actually have been driving the US dollar lower and precious metals higher. So again, we saw a bit of a pullback last week on precious metals, which is, particularly normal. There's a lot of reasons behind it. However, what our predictions are for the Canadian dollar, US dollar exchange rate for the next 12 to 18 months is in that 72 to 74 cent range when you look at the conversion. Now, again, this is a change from last month. Last month, we were thinking 69 to 72. That's increased a little bit higher because the Canadian interest rates are likely not going to change. But with a lower interest rate from the Fed, especially after Friday's announcement, it is possible that the US dollar could go lower. And as people dump the US dollar, if they go into precious metals or other safe haven assets, it's like I said, a lower US dollar is great for their imports, not so great for the exports in the United States. So we're keeping an eye on that, but again, within the range, and very comfortable with where we're at right now. So moving on to government budgets. So if you look here, we've got additional fiscal spending from all developed nations. And if you look back 10 years, Canada, US, Germany has reversed course. They're all spending a lot more. And so this is going to trickle down into the economy. And this is something that fiscal budgets are important, and they also create a lot of stimulus in the market. In the United States specifically, Congress passed the One Big Beautiful Bill last year. Those are starting to trickle down this year. So in 2026, the estimated savings for a middle-class household is about $2,900. That's in extra cash that they're going to have in their pockets. And if your incomes are over 217,000, those households are going to get over $12,000 in refunds. And so a lot of the time, those dollars end up back in the economy, back into equity markets. Again, we're not saying that equity markets are going to continue to rip higher, but it is money that is going to be stimulative and continue to keep the economy growing. Speaking of growth, a lot of the US AI companies, or I guess call it tech companies, are spending on average 35% more than they were last year in tech spending. And so that includes infrastructure, racks, chips, heating, data centers, all of those things. There's a lot of innovation behind that because they want to make sure they are on the cutting edge. An underinvestment here is a huge risk to a lot of these companies. And where do they get all of their products from? They get them from Taiwan, South Korea. Semiconductor sales are something that we track very closely. And you can see here the increase in semiconductor sales over the last several months. It leads to, growth in world markets. So the more things you sell, a lot of those items have microchips in them, and you have products that are getting sold, and then you've got earnings growth on top of that. And so it's interesting to see all of that grow. Some of the kind of final words that I wanted to talk about is that there is this wealth effect wave, is that on average, about the highest income earners in the United States, and this is a study done by Visa, they own about 85% of the equity market. So the middle class and people that have investments passively or otherwise, they don't own a ton of assets or a ton of equities. It's actually the kind of the wealthier cohort. Now, what that really means is that when they see their balance sheet start to expand, they actually have, for every dollar of expansion, it trickles down to about 34 cents of additional spending in the consumption. And so the wealthier you feel, the more you end up spending. And again, this isn't to say that there's a disparity here. It's just to say that we know that as markets go up, the balance sheets of these people go up higher. Even yourselves, if your balance sheet is coming down because you've paid down some debt, you've got some extra cash, that cash ends up usually going into purchasing stuff. And that stuff grows the economy. My final words here about volatility is that what you're seeing here is the calendar year return every single year. And as you can see, we've had 3 phenomenal years, 24, 23, 16% in the US markets. It was actually 2022. A lot of people forgot because the market downturn actually happened near the end of the year, but we were down 19%. But what the red dots signify is where the lowest point of that market was from the previous peak. So from peak to trough, every single year, there's a few exceptions, there's always been a down period. Last year, it was down 21%. The year before, down 2%. But you can see that volatility is part of the investment thesis. And so if you're worried about markets crashing or bubbles bursting or anything to do with your goals and your portfolio, this is an excellent time to have that robust meeting with your advisor and our team of experts that we can dissect your portfolio. If you've got assets outside of IG that you've seen grow, or maybe you're not sure where they're performing, we can absolutely look at those things and provide you with an objective opinion of where we need to rebalance, where we need to take some profit, maybe we need to dump things. Otherwise, stay the course. If you're a long-term investor, we encourage you to just take these, little downturns here and there. There's little to say that the recession risk is around the corner, and we're pretty confident heading into 2026 that it's going to be a fantastic year. Again, I apologize for not being there in person, but please follow us. The QR code you see in front of you is our podcast. We have a weekly show. We also have a weekly newsletter if you're not already subscribed. And from time to time, we send out emails to our advisors, updating them on the current state of affairs. It was my pleasure, again, to join you virtually. I apologize if I do get a chance to make it up to Fort McMurray in the next few months. I will definitely come and say hi again. Thank you very much and have a wonderful evening.